Hi, and welcome to our LinkedIn Live broadcast on the release of the ISM Services PMI Report. My name is Dan Zeiger. I'm Senior Writer and Editor for Inside Supply Management, which is Institute for Supply Management's member publication. And welcome to our discussion as we break down the Services PMI data for July. Although employment contracted, the sector that makes up most of the economy was steady. Business activity and orders were brisk, despite nagging high prices. The Services PMI reflected that stability. It was up just 1/10 of a percentage point to 54.1%. So there's a lot of data to break down and translate into actionable insights for our viewers over the next 30 minutes. So I know a really good guy to help us with that. He is Steve Miller, and he's the chair of the ISM Services Business Survey Committee. How you doing, Steve? And just what stood out about the July data?
Good morning, Dan. Good to be here. Four things. The first thing was employment number low. That was a bit of a surprise given the strength of everything else. The second one was order backlog and the drop in the order backlog. Still in expansion, but just above 50 now. The third one was the strength in the other indexes, the new orders and business activity were really good numbers. I think business activity was the second highest in the last 26 months, and the new orders was fourth or fifth. I guess it's fifth highest in that same time frame. So that was a big deal. And then the fourth one is that we have a PMI reading of 54.1 with an employment reading of 47.3. Just as a reminder to folks, if you take any one of those four, or 47.4, if you take any of those four sub-indexes, the business activity, new orders, employment, or supplier deliveries, and divide it by 4, that's what the contribution is to the PMI. So if we had an employment of 50, which would be 2.6% higher, that would be 54.8 about. So really strong numbers. We're back where we were last month, basically 4 percentage points higher. We would have been at a 55. So really good numbers. But just a couple things that kind of pop out at you as kind of interesting. The prices one, it's kind of around where it's been for the last several months. It's a little bit of a psychological impact to see it back above 70, but it was at 70.7 and 70.7 and 71.3. Down for 1 month and then to 70.3. So not really shocking there. That one wasn't one that really stood out to me much, but the others certainly were.
Well, let's talk about the employment number a little bit, since we did a little back of the envelope math on it. Was that kind of a surprise? I think you suggested that it was, or a disappointment. It was an expansion for just 1 month, down 3.8 points to 47.4%, as you said. And I like to share these percentages as we talk about it. Of the companies surveyed, 14.3% reported hiring. That's down from 16% in June, 16%, while 19% reduced headcounts. That's up from 10.9%. I mean, I know that's just one data point, but I don't think I've ever seen an 8-point swing like that I can remember. I know we had mentioned the event factor last month, and you said earlier that, that really wasn't a big factor because accommodation and food services did fine. And we've talked about AI from time to time over the last few months and that potential impact. Just kind of break that down a little bit further about how that employment number came out like it did.
So Dan, for me, the big one was looking at the backlog of orders and the commentary. So we had a backlog of orders number of 50.9, so just above 50, but not anywhere where it was, the previous 5 months, where we were 54, 51, 53, 53 and a half, 55.9. So really strong numbers over the prior 5 months. If you're a services industry and you're able to keep up with new orders and reduce your backlog, or at least keep your backlog from growing, there's no reason to hire new people. Well, if you're testing out AI and you have some preliminary impacts that are looking good, and then you've got investments that you need to compensate for. It all seems very logical, even though it was a bit unexpected, given that number drop. Looking at the number further yesterday, Dan, I just looked at kind of what the history is of those employment numbers, and I looked over the last 18 months, and I looked over the last 12 months. So over the last 12 months, we've been at 8 below 50. If you look at the prior 12 months, over the last 9. So if you look at the 12-month running average for the last 9 months, which takes us back before the first of the year, 8 of the last 12 months were below 50. So 2/3 basically, except for 1 month where it was 9, and that was in May. So there's one other time in the last 15 years that it's been like that. And that was, that was 21 months ago, almost 2 years ago. For the prior 7 months, we were at 8, 9, 10, 9, 8. Then you've never seen a string like that or a percentage like that until you go back to 2011. So something's different. I don't know what it is. Is it AI? Is it just the amount of uncertainty that was going into businesses around the war, around tariffs and all that? Just kind of the, what's it going to be today? That has people reluctant to hire and more confident contracting or such. Don't know for sure, but there's something different over the last 9 months that is very different than anything other than one other 9-month time period in the last 15 years.
That was definitely one of the more sobering elements of the report today, that historical perspective that you provided in an earlier call. And I don't mean to devote this broadcast to half empty stuff, but we'll get to, there were a lot of good numbers, the demand numbers obviously, and we'll get to those. But obviously the prices number index is always going to be standing out in recent years. Ticked back above 70% for the fourth time in 5 months. It was 70.3%. Silver lining, perhaps, as you pointed out, 6 commodities were listed as down in price. That's up from 3 the previous month. My math was correct. I counted 23 that were up in price. That's down from 28 the month before. We're still waiting for a resolution in Iran, and while markets can recover quickly, supply chains can be a different story. So just discuss that situation.
Sure. And I don't know, Dan, whether I mentioned this on the LinkedIn Live last week or last month, or whether it was in one of the interviews, that I wouldn't be surprised based on the limited flow through of petroleum-related products. We saw some commentary, but not a lot of commentary last month. And the prior month, it was expected to see petroleum-related products flow through of higher prices paid. Now we're in the 3rd month of petroleum-related products higher, and plastics 2 months in a row. We've seen that reported as commodities up in price. So I still expect to see that continue to flow through the supply chain for at least the next couple of months. And I think that it's fair to say that based on the other numbers that you highlighted, where we're seeing overall reductions in some areas, but we're still seeing in petroleum related up in price. We're seeing gas prices kind of up in price again, diesel up. We're still $20 a barrel higher than where we were back at the beginning of the year in January. So I expect to see that continue. Not to be shocked, because it's fully understandable. It's also something that that World Oil is starting to address by looking at alternate means to move oil than through the Strait of Hormuz. If that problem gets solved in the next couple of months, it's reasonable to expect by the end of the year we'll see numbers low 60s, maybe even high 50s. But I don't see that happening here anytime in the next 3 to 4 months, just based on how long it's taking those higher prices paid for petroleum-related products to flow through. And petroleum's in everything. It's in everything, almost everything.
You had mentioned or you were asked about it perhaps, but you brought it up. I thought it was really interesting in an earlier call as it regards to prices and especially capital expenditures. If you're paying higher prices and you may be paying higher interest because you're financing stuff, that means that's less stuff that you can buy. I thought that was really interesting that you talked about that in an earlier call. Just elaborate on that. The interesting dynamic that maybe companies and supply managers are contending with or have to think about.
Viewed that as a gap in my thought process when I saw the mid-year supply chain forecast. It was looking at a significant increase. Was it 8.5%? It was somewhere up in the high single digits of increases in capital spending. And so I'm thinking, okay, people are going to be investing to grow capacity, which more so than they have historically because of that increase in spending. I wasn't viewing it as just a flat out price increased cost of capital equipment and increases in financing costs. What we're seeing is elevated financing costs. That's coming through in the commentary, whether it's mortgages or just financing. And then the second piece is higher prices paid on key capital equipment and SaaS software, which is where AI investments are. And we're seeing SaaS companies increase their pricing with the rationale of, oh, we're adding AI, so you'll be much more productive with our tool set. So underestimating that in looking at the capital investment. Now, SaaS won't be a capital investment for the most part. SaaS is going to be expense, but the equipment that you need to run it, in some cases, if you're not off-prem cloud with one of the cloud services providers, you may have some capital or capital leases involved in that off-site stuff. So yeah, so for me it was, I hadn't, when we first looked in May or June in the mid-year, I hadn't interpreted that as, oh, maybe it's just a representation of higher costs. Now I'm thinking that's got to be a significant component of that increased spending.
Well, as you pointed out in the introduction to the report and the summary, in light of all those dynamics that we've discussed up to this point in the call, the services sector has been very resilient. The demand indicators looked great. Were robust with the business activity up to 59.1%, new orders 57.2%. That's strong growth no matter how you slice it. I know demand has been good for a few months now, but at this time of the year came into my mind yesterday as I was thinking about it. We're coming to a new fiscal year. That's always a time of increased activity in the services sector. Was that a slight factor this month, or was it just continuing good demand?
So we did see some commentary on seasonality as well as fiscal year impacts. So I think that's a correct insight, Dan, from you. In looking at it, it does look like we've got some of that, driving our demand. It's a really high number though. So if you look over the last 26 months, this is the second highest business activity reading during that time frame. If it's seasonality, we should have seen that seasonality 12 months ago, too, not just now. And when I look back at the number on, when we saw that business activity number then higher than 59.1, it was in February, 59.9, when our respondents were telling us there was increased activity to get ahead of petroleum cost and transportation cost impacts. Back in the July timeframe last year, we were at 53 versus 59. And when you look through the summer, June, July, August last year, 53.9, 53, 54.6 versus June and July of 55.4 and 59.1. So I don't think it's a seasonality thing. I think it's really a strength of business across the board.
Kind of a two-part question here, or a combined question, if you may. The supplier deliveries index, that was easing, continuing in July. It was down to 52.8%, which was kind of interesting considering some of the disruption challenges and what we've got going on in certain places in the world, indicating delivery performance improved a little bit. And yeah, there was a lot of activity in the commodities list. Not to say there weren't supply challenges, which I know you'll discuss with certain commodities, but I mean, transformers were no longer in short supply. There were 4 commodities that were listed as up and down in price, which can happen because of market volatility. Those were aluminum, diesel fuel, and gasoline, which is probably no surprise to anybody. But yeah, just discuss the supplier delivery performance in July, and in light of everything that's going on, and some of the challenges that are there.
Sure. Yeah, I didn't see any commentary that was talking about significant increases in supply chain disruption. So I think that refresh the 52.8 is a mathematical solution from all of the respondents, their industries, weighted by their percentage of GDP impact. So when you get to a 50, it's looking at kind of half of the services sector is seeing slower or same, and half of the services sector are seeing faster or same. And so we're just slightly above 50. The 52.8 is the lowest that we've seen since December. So knowing we've got smart supply management people, our jobs are to figure out, so what's going wrong and how do we fix it? We're fixing things. So from my view, nothing new happened last month. It was continuing the same, some tariff uncertainty, and certainly some continued ups and downs in the strait. But people have had time to do risk mitigation, use alternate courses, and do some shifts from that perspective. So my view in the overall, looking at that, and shortages dropping, it looks like we're figuring it out, and it's continuing to trend in the right place, meaning that more companies are shifting from that slower to faster, bringing that overall number down. Not that it's continuing to be slower overall for the services sector. So there's still challenges, but it's getting better for many industries.
Yeah, well, let's camp in that logistics tent for just a minute. I think this is a fun question. I hope you think so too. It's an opportunity to go to supply chain school for a little bit. But you had mentioned in the report that some panelists had cited such tactics as extending ordering windows to accommodate longer lead times for certain commodities. Yeah, how might that approach work for some of our viewers and their companies?
Sure. In your ERP, you have a lead time for products, and especially if you're at construction, utilities, you have some that can be 2-year lead time or 12-month lead time. If you have your ordering window to say, when I hit 12 months, order a transformer, and you're finding out that transformers are now 13 months or 14 months lead time, you update that window to be 14 months. So when you see when you're going to need that transformer and it's 14 months from now, you order it. That way you're not 12 months in saying, oh, it's still going to be 2 months, and you're caught short. So if you open those windows, make them a little bit longer lead time and order them sooner, you take an inventory risk. The reason why you don't order it is because it costs you money to order it earlier. In many cases, you've got to put a down payment, a 50% down payment, or something like that, or you've made a commitment. And the further out, the less demand certainty you've got. So it's a risk trade-off of, can I afford to not have the item versus am I willing to make that commitment to the inventory, make that commitment right now. And it looks like we're starting to solve those for the most important items.
Well, it's time for our monthly comment that we expand on a little bit. And I know in recent months or over the months, we've had some fun with some of the more negative or biting ones. But I mean, this was a positive comment. It came from a panelist in wholesale trade, and he or she wrote, quote, "The business is more robust than expected, considering some of the economic headwinds still plaguing the industry. Lumber supply is tighter and freight rates and availability are challenges, and most of our builders are pushing back hard on price increases. However, the outlook is favorable for the remainder of 2026. This panelist discussed some of the challenges that industry and her company, his or her company, is facing. We've discussed them throughout this call so far. But yeah, talk about that sentiment. I mean, does it kind of typify the resiliency, of the services sector right now?
I think it does, Dan, and in some cases, for specifically the wholesale industry, it's so broad. It supports so many different of the services industries. When you isolate down to construction and utilities, it's certainly construction specifically. It's a tale of two cities. You have industrial construction and you have residential construction. Residential construction is hurting. Mortgage rates are too high. Inventory is up. Different home builders are providing incentives. I was just talking to a friend of mine 2 days ago, getting a 1.9% mortgage rate if he buys now. It goes to 2.9% in year 2, 3.9% year 3, 4.9% in year 4, and then up to potentially 8.9% in when the number adjusts. And that's coming at the cost of the builders. They're the ones that are buying down those mortgages so that they can move inventory. And they've been doing it for a while. It's starting to, I think I mentioned on Bloomberg, it's threadbare at this point. They're starting to and so the reason why I bring it up is that wholesaler talking about they're getting pushback on pushing through price increases. That's specifically why. They were already giving up margin, buying down. They're already giving up margin through some of the steel and other price increases and tariff increases that they saw early in the year. So now it's, we just can't take any more kind of commentary that I think we're seeing on that side. On utilities, it's build, build, build. I had one of my former roles, it was, look, you save money. That's great. We love money saving ideas. Just want to let you know, if you delay our opening of rooms because we're getting lower priced furniture, the cost per night is equivalent to half of the savings that you're going to generate for the room. So if you delay me by a month, this will be a real problem for me. So don't delay. So when you look at utilities, there's such a revenue opportunity out there right now. They've got to get the utilities built. They've got to get the data centers built. So that's where we're seeing that continued pricing pressure on some of the items like transformers, where they're not on the shortage list anymore, but people are willing to pay enough for them to get that stuff in action now.
We've got about 3 minutes left. And before I do get to the usual last question I have for you, I did want to highlight a couple more positive readings. New export orders, 52%. Imports indexes, 51.8%. We talked specifically about imports last month, and that was kind of a concern, but obviously an encouraging turnaround. One panelist did write that international new orders were modestly higher than last month, supported by resilient demand from key export markets, despite ongoing geopolitical and trade uncertainties. Yeah, just how nice was that to see that kind of a turnaround, especially in the imports, and gives us a chance to kind of talk about the new suite of tariffs that was announced last Friday. How big of an impact could that have?
Yeah, as a U.S. citizen, I'd much rather see increase in export demand than I would increase in imports. But it does mean that we have some continued optimism in the business, especially seeing that we saw inventory tick up a little bit and inventory sentiment tick down a little bit, meaning we're more confident that we've got the right level of inventory, even with a higher level than we had last month.
Well, our viewers know that Steve knows his stuff, and he's given a lot of actionable insights that I hope you guys can take away over the course of our call here. But I will ask my usual question to wrap it up. If I'm a CEO or a high executive, what are some of the other takeaways other than what you've discussed already that I should have from the data? Especially with the things changing as rapidly as they are, especially in the next maybe 30 to 60 days, what should I have in mind?
Dan, I think you covered it today. I really don't have much more to add. We're going to continue to see uncertainty on oil prices and petroleum related products. So if I had any watch out, that would be the area. We covered that a little bit earlier, but that would be my one kind of priority to take away from this month's reading. Is it higher prices paid and more to come on petroleum related products?
Well, yeah, like I said about the manufacturing report on Monday, the good thing for companies and supply managers in the next 30 to 60 days. Well, in 30 days, we're going to get another Services PMI report to break down and analyze. So that's always a benefit. Hey, thanks for joining us, Steve. I appreciate the time. And thanks to you for joining us today. In a bit, you can go to ISM's website and read the roundup article that details a lot of what Steve and I have discussed here. And if you want to be a part of the ISM Manufacturing or Services Business Survey panels that break down and compile data for the ISM PMI reports, you can go to ismworld.org/join the panel for more information. Hey, we'll see you back here in a month when we break down the ISM PMI reports data for August, manufacturing and services. So for Steve Miller and some people who helped us behind the scenes, they are Christina Cahill and Jennifer Stevens. I'm Dan Zeiger, and we'll see you next time.